Hey, it's Tom here and welcome back to the channel. So in the last couple of days there was a new interview that came out with the still relatively fresh CEO at Seritage Growth Properties, Andrea Olshan. She sat down and did about a 30-minute interview with NAREIT, or the National Association of Real Estate Investment Trusts, and I found it really insightful as a Seritage shareholder myself. So I want to basically give you the highlights from that interview in this video. If you want to check out the full interview, that will be down in the description below, but it covered some really important topics that I found super interesting. So things from how they're thinking about selling some of the properties that they don't want to redevelop, how they're thinking about the properties that they do want to redevelop, and how they're now categorizing them into a few key groups, and also how they're thinking about the debt that they currently owe to Berkshire Hathaway. So let's get into the highlights video. If you do enjoy it, please hit like and hit subscribe, but for now, let's get straight into it. Okay, so Andrea Olshan basically started this interview out by talking about how she viewed Seritage from the outside looking in only a few months ago when she was starting to go through the interview process to become the CEO at Seritage. And she basically came to the conclusion that Seritage was really difficult to understand. So it was hard to figure out what the true value of the properties are. It was hard to figure out how they're looking to create value and what their strategy is. So she, as the new CEO, was doing a lot of work to try and kind of simplify the investment thesis for people assessing Seritage for the first time. Not only investors, but also potential lenders, because as I'll talk about shortly, they are potentially looking to get some more attractive terms on their debt versus what they're currently getting at Berkshire Hathaway. So in order to make that happen, they really need to be very clear on what the true value of the properties are, and also very clear on the timeline for redevelopment and the value that that will create. So from the outside looking in, she did find that really tricky, and now that she is sort of within Seritage, they've done a lot of work to basically go through and assess every single asset, every single property that Seritage owns, and basically try and figure out what they are going to do with it. Is it an attractive proposition for redevelopment? Should they spend cash and maybe take on some debt in order to redevelop some of these properties? Or are they better off just not owning it and selling it and reallocating that capital elsewhere within the business? So of course, many of you will already know that all of these Seritage Growth Properties assets are basically old Sears stores. Andrea Olshan talked through how the average property is about 13 acres. For people that happen to use the metric system like myself, that's about 5.2 hectares. And they've basically gone through and, like I say, figured out sort of what they want to do with each of these assets. So generally speaking, they have tried to slot each individual property into one of 6 categories. And this was actually also presented in a recent slide deck which Seritage put out a couple of weeks or so ago. I'll also leave that link down in the description if you want to check that out as well. But these are basically the 6 key buckets that Seritage sees each of their properties fitting into. So the first category in the minds of Seritage Growth Properties is grocery anchored retail. Hopefully pretty self-explanatory with grocery stores renting out some of these SRG buildings. The second one is strip center / multi-tenant retail. The third one is single tenant. Fourth one is office / life sciences, which as far as I can understand it is sort of like lab facilities. The fifth one is residential, and the sixth one is built for rent. So Andrea Olshan talked a little bit about how they've got some very high credit tech companies that they're in negotiations with at the moment around building facilities specifically for those businesses. So that's what built for rent refers to. But those are sort of the 6 buckets that Seritage are now kind of slotting each of these properties into. Now, throughout the presentation, Andrea Olshan also talked quite a bit about these triple net lease structures, which is, by the sounds of it, Seritage's sort of preferred way of leasing out some of these properties. Now, a triple net lease basically refers to the 3 general nets that capture typical costs of renting out a property or maintaining a property. And basically, those 3 main nets are property taxes, insurance, and maintenance. So when they say that they've got a triple net lease, basically the property taxes, the insurance, and the maintenance are all sort of put onto the tenant. So the tenant is paying for these things. Generally, that means that the tenant will also pay slightly lower rent than if the landlord was covering a lot of those costs. But from the perspective of the landlord and of Seritage in this case, it's a low risk way for many of these businesses to rent out their buildings. They're not going to have a bunch of unexpected costs pop up if they've got some of these triple net lease agreements in place. Now, next up, there was quite a bit of talk about debt. So, if you don't know already, the current sort of debt situation at Seritage Growth Properties is they have Berkshire Hathaway, which is currently lending them $1.6 billion. So, all of the debt is to Berkshire Hathaway, and it's all at sort of the overall kind of corporate entity level. So, Andrea Olshan talked about how she actually did a bit of name dropping here and mentioned Warren, Charlie, and Ajit. So, Warren Buffett, Charlie Munger, and Ajit Jain, and mentioned that they have good relationships with all of those people. Berkshire Hathaway understand what Seritage are trying to do in terms of understanding the value creation Seritage are trying to achieve with their redevelopments, and why they're selling off certain properties and so on. But Andrea Olshan also said at the end of the day, it's very expensive money. So Seritage are paying about 7% interest on that $1.6 billion from Berkshire Hathaway. They also have about a $400 million amount that they can borrow, over and above the $1.6 billion to take them up to $2 billion in total if they meet certain income requirements. And I believe they pay about a 1% interest rate on that unused money as well. So pretty expensive money. They also mentioned that the preferred shares for Seritage Growth Properties also are about at a 7% interest rate. So a lot of very expensive financing going on at Seritage, and they said although they really like working with Berkshire Hathaway, there are probably much better opportunities to be had in terms of trying to find cheaper financing. So Andrea Olshan talked about how market rates are more like about 4% these days, and if you figure out what that interest rate difference is across $1.6 billion of debt, it's a very, very significant amount of money in the context of Seritage. So if you save 3% in interest by going from 7 to 4 on that $1.6 billion in debt, that comes out by my maths at close to $50 million a year. Now, this is a $1 billion roughly market cap business, so $50 million a year saving is quite a significant cost saving for Seritage. So not particularly surprising for me to hear that they want to refinance some of that debt, but really nice to have Andrea Olshan talking very openly about how they're thinking through that process. Now, a little bit further on debt, Andrea Olshan, as far as I could interpret it at least, was quite interested in potentially having debt at the individual property level. So, like I talked about earlier, currently the debt is at sort of the overall Seritage level, and they're using things like a loan-to-value ratio by looking at book value. So, they're looking at the total book value of Seritage and sort of lending on that number. But one of the things that that book value number doesn't include, it doesn't give basically any credit to the potential value that can be created by redeveloping some of these new properties. So Andrea Olshan is really thinking that if they can assess the value of individual properties with particular lenders, they can potentially get access to a lot more attractive financing and also potentially not have to give away as much equity in a lot of these redevelopments. Because the end goal here, as Andrea Olshan described it, is to use debt creatively to own a very big piece of massive, very exciting developments. Okay, so the next big topic that was covered was what does the pathway to positive cash flow look like? Because if you've looked at Seritage in any depth, you will know that they are burning cash left and right at the moment. So there really has to be a stop to that at some point, and the question was basically, how do we get there? So this is probably the quote of the entire interview that came out from Andrea Olshan, which was, we're all NAV, and NAV is net asset value if you're not familiar. So we're all NAV all day long. If you're looking for cash flow today, we're not your girls, but we do have tremendous opportunities. So kind of funny to hear it in that context. But I completely agree. I mean, the investment thesis in the first place from my end was they have a big discount to net asset value at the time that I was buying the shares. There is a pathway to cash flow at some point in the future, but there's sort of downside protection from the net asset value that you're getting. So Andrea Olshan also said the pathway to cash flow is very clear, but again then talked about the use of debt, and at the moment how they're really just purely using kind of cash to fund some of these new investments, which is not the way that she necessarily thinks it should be done. They are sort of selling off a lot of properties in order to fund with cash some of these redevelopments. They're not really taking on any more debt after the full $1.6 billion they've already extracted. So by being able to shift that debt down to the property level, they're potentially able to borrow a little bit more money and still have a lot more equity in the game on the other side of these redevelopments. And a little bit further on trying to get to the point of positive cash flow, they said they have made a lot of changes at headquarters, so they've leaned out their cost structures a lot, and they've even actually sort of divided the Seritage Growth Properties team into 6 sort of sub-teams, with each team looking after one of these buckets of property sort of categories that I talked about earlier. So whether it's grocery or life sciences or so on, they've basically got a team that looks after each of those segments of Seritage Growth Properties portfolio, and they're really trying to reduce costs at the corporate level as much as they can, and also use property sales strategically. So in the past, Seritage Growth Properties have sort of slowly been selling off properties that they don't want to have in their portfolio in order to generate cash and keep kind of funding the redevelopments. And Andrea Olshan basically described that as, in the past, sort of been done for liquidity reasons. So Seritage would start to run out of money, they'd sell a new property, they'd have a bit more cash for a while, they'd again run out of money, sell another property, and kind of just repeat this over and over again. Whereas the way that they're thinking about it now is they've gone through this full overview of the portfolio. They've said these are the 6 categories of properties that we want to own and redevelop, and these are the properties that we really don't want to own in their portfolio. It doesn't necessarily mean they're not valuable, it just means that they're not as attractive for a redevelopment opportunity as some of the other properties in the portfolio. So they basically said you can expect the property selling to speed up, because they're now not just going to sell properties for liquidity reasons, they're going to sell properties just because they don't want them in their portfolio. They'd rather spend the money on redeveloping properties that they do want in their portfolio and not just kind of hang on to these laggards that they don't really want to own at the end of the day. So that was also an interesting comment to hear. Now, a couple of final topics or sort of discussion points that came up that I found really interesting was basically describing the initial transition away from Sears. So back when Seritage Growth Properties first got spun out of Sears as its own entity, they still had about $210 million a year coming in the door from Sears. And that basically gave the people sort of reviewing some of the individual properties the opportunity to just sit and think for a long period of time. And all of a sudden, basically, that Sears revenue started to slowly go down, and then suddenly the tap basically turned off, and that $210 million of Sears revenue went to effectively zero in quite a short space of time. So that put a lot of pressure on trying to redevelop some of the properties, like I say, and that's the reason why they've been selling off some of the properties they don't need in order to generate some cash to keep funding some of these projects. So that was sort of like the context leading into what they're currently doing. And in terms of the timeline for when they expect new developments to come online, it was really interesting to get some thoughts on that. So Olshan basically broke it into sort of short, medium, and long-term projections or estimates of what they want to do. So in the short term defined as anywhere from 6 to 18 months in this case, they expect some of their triple net lease grocery anchor properties to come online, and also some of their multi-tenant retail properties to come online, which is fantastic to hear. In the medium term, they expect more multifamily to come online. They actually described multifamily real estate as being quite quick to build. Really the thing that holds them up from putting those buildings in place is largely getting entitlements and permits and so on to actually build those facilities. So the actual building process is quite quick once they do get that stuff across the line, but that's really what's holding them up with that one at the moment. And in terms of the long term, that's when you get into some of these really big projects. So you're getting more into multifamily, and you're starting to look at these properties that I've described in previous videos. So the big Dallas development, Redmond and Hicksville are also good examples of that. Really large properties where they want to do pretty big development projects. And they actually also talked about sort of refining the plans at some of these big projects more recently. So in the second live stream, for example, that Brad and I did on Seritage, we talked about how at the Dallas property they were looking to do some multifamily, also some retail, and also some office buildings from memory. They've actually decided to pull away from office a little bit, so they're leaning more into multifamily. Again, it's a little bit quicker to build, and they think it's a better use of capital, frankly. So they think it will be more profitable, cheaper to build, faster to build, all that sort of stuff. And they think there's far more demand for the multifamily than there is for things like office. So on the Dallas property, for example, they've adjusted the plan so that they have about 500 more multifamily units than they initially had anticipated. And a few final comments from the interview that came up. Again, they sort of reinforced that it's a NAV story all day long and a value creation story all day long. There's a clear path to cash flow, but they're not there just yet. And again, they also reinforced that they're really trying to demystify what Seritage are doing and make it clearer for investors. So they sort of hinted at some potential new presentations coming out fairly soon, so something to look forward to there. So again, get a bit more of an understanding of what Seritage are actually trying to do at the end of the day. It's one thing to go through and try and assess what all the properties are worth, but at the end of the day, they do have to be redeveloped and rented out. You can't just burn money forever, as far as I'm aware at least. So really interesting interview from Andrea Olshan. It was one that I really enjoyed and gave me a lot of clarity as a Seritage shareholder, and I'm kind of really appreciating all this extra information that is coming out. So hope you enjoyed that little summary. Like I say, the full interview will be down in the description below if you want to check that out. If you've checked it out already and you think there's something I've missed, definitely drop that down in the comments below, or if you've got thoughts on any of the things that were covered in this video, let me know as well. So hope you enjoyed it. If you did, please hit like and hit subscribe, and I will see you in the next video. Cheers.